In this video, I'll review the first quarter financial results of one of my REIT holdings, ticker M44U Mapletree Logistics Trust, or MOT in short, and give you my opinions about it. I'll go through the points from their official presentation slides, such as key highlights, financial and business outlook, and translate them into layman terms to make it easy for you to understand so that you don't have to. What's up guys, it's Christopher from Honey Money SG, and in this channel we are all about building financial knowledge, teach money saving hacks, and also help you lead a fulfilling quality of life. So disclaimer first, this is not financial advice, just treat it for entertainment purpose and knowledge sharing, and I do own shares of Mapletree Logistics Trust as described in my REITs portfolio review earlier. So today, let me take you through the official slides of Mapletree Logistics Trust and walk you through the presentation. So do you know that most of the companies actually publish their results quarterly and in a very nice form of presentation slides, but most of us don't have the time to read through all of them. So here I am helping you to go through. So with that, let's go. Alright, so here is the Mapletree Logistics Trust financial results published on the 19th of July 2021 for the first quarter financial year 2021 and 2022. Let's move on to see what is the agenda. So we have key highlights, financial review, capital management, portfolio review, and the business outlook. So let's start off with the key highlights. So point number 1. For the first quarter, the amount distributable to unit holders of $92.7 million, up 19.1% year over year. And also DPU is up to 2.161 cents, which is 5.7% on an enlarged unit base. So we see gross revenue rose 23.7% to around 164 million, and NPI grew from 21.3% to $144.2 million. So very good. You can see the revenue growth double digit, and the net income actually grew by 21% as well. Anything that is above double digit, especially above 20%, I think that is a very good business result. And you can see the performance being driven by higher revenue from existing properties, as well as the accretive acquisitions completed in the financial year of 2020 and 2021. So this includes the redevelopment of Mapletree Olo Logistics Parks Phase 2. So most important metric, if you remember in my REITs portfolio review, is number 1, DPU must increase consistently year over year, so they have achieved this. And second point, let's look at the resilient portfolio. So what is portfolio occupancy? It basically means how many percentage of your properties are occupied. So you can see that their portfolio occupancy has risen to 97.8%. So last time they are 97.5%. So slight increase. Any increase is great. You can see that they are near 100% fully occupied. So you want your tenants to actually occupy your property so you can earn rental income, right? You don't want it to be vacant, so that's good. They have a well staggered lease expiry profile with a weighted average lease expiry of 3.8 years. 3.8 years is a generally comfortable length of time. And also average rental reversion for leases renewed or replaced in 1Q was 2.2%. So reversion means how much percentage has the rental rates increased. So 2.2% is good. As long as it's positive, I'm good. As long as it's not negative, that means the landlord, Mapletree Logistics Trust, is earning more money. So proactive capital management, leverage ratio decreased slightly to 38.2%. So this is a percentage ratio of how much of their capital is financed by debt. So for REITs, anything below 40%, I think that's healthy. Anything above 40 to 45%, I think you need to have a more critical look at the financials and see whether it is justified. Well staggered debt maturity profile of 3.7 years. That basically means how long is their long-term loan. Okay, approximately 75% of total debt is hedged to fixed rates, and around 75% of income stream for the next 12 months have been hedged to SGD. So they are saying that don't worry about currency fluctuations, we are hedged, so you won't see a lot of foreign currency translation gain or loss in their statements. And they also mentioned that they have more than sufficient liquidity to meet maturing debt obligations in 21 and 22. Post quarter end announced proposed acquisition of 9 Changi South Street, Singapore for $24.5 million. So we'll take a look at this in the detailed slide later. Okay, moving on, let's see the financial review. Let's start with the year over year review. So this is the first quarter 21 versus first quarter 20 result. So let's see, on the left here we have the current year, which is first quarter 2021 Revenue is around $164 billion, up from $132 billion 1 year ago. That's 23% change. Property expenses increased by 44.7%. Oh, that's quite a big increase on property expenses. But if you look at the net property income, or we commonly known as the net income, you can see that net property income has increased by 21.3%. So that is already a very good performance. And we look at the revenue growth is mainly due to higher revenue from existing properties, accretive acquisitions completed in 20 and 21, and also completed the redevelopment of Mapletree Olo Logistics Parks. So they have more income sources on one hand. On the other hand, they also have better rental rates, right? If we look at the previous slide, we talk about having a rental reversion of 2.2%. So they are earning more from their tenants. But if we look at property expenses, you see this huge increase. They also explain that it's mainly due to acquisitions completed in the financial year of 20 and 21. So they need money to acquire more property, right? And that will bring in more revenue in the future. So that's okay. Borrowing costs has increased due to incremental borrowings to fund 20 and 21 acquisitions, partly offset by lower interest costs arising from lower average interest rates. So because of this low interest economy, we are seeing record low interest rates, right? So you want to borrow more to take advantage of the low rates, especially at this period of time. So that's fine. If you look at the amount distributed to Perp security shareholders and also unit holders, then you can see your distributable income increased by 18.1% from $82 billion to $96 billion. But that's not the important thing. The important thing is the DPU. How much are you getting per unit of your share? So you see that it has increased from 2 cents last year to 2.16 cents this year, 5.7% increase, which is good, right? For the same unit of share, you are now earning much more, 5.7% more than what you had in the past year. And last year, they actually had an equity fundraising exercise and the purchase consideration were paid in units, so they issued more shares lah. So if we were to exclude any divestment gains, the amount distributable to unit holders actually increased by 24.4% and the adjusted DPU increased by 10%. So here I explain that divestment gains was $1.8 million in 1Q 21-22 versus 4.7 M in 21. So if we exclude that, it will grow by 10.3%. What it means here is that last year, they actually have a huge divestment gain of $4.7 million, right? So when you divest a property, you actually realize your capital gains. That's what it's talking about. So if we were to exclude all those capital gains from the divestment, and we look at the raw business operations of Mapletree Logistics Trust, they actually gained 10.3% DPU, which is even more impressive, right? And you can see from the footnotes over here, this year they already have 163 properties, while last year they only have 145 properties. So they are very aggressive in acquiring more properties to increase their income sources. So that is good as a REIT manager. You want them to acquire more properties accretive to the DPU so they can earn more distributions. Right, let's move on to the quarter-on-quarter performance. 4Q last year versus 1Q this year. So if we look at the quarter-on-quarter change, gross revenue only increased slightly by 4%. Property expenses decreased by 4%. Net property income increased by 5.5%. Revenue growth is coming due to the contribution from existing properties as well as some acquisitions in South Korea and India completed. So again, they have more property rental income coming from South Korea and India, and also the property expenses decreased because there's a lower recognition of allowance for doubtful receivables, partly offset by the full quarter contribution from acquisitions completed. So they have lower bad debts lah. Okay, borrowing costs increased due to full quarter impact of borrowing costs to fund the acquisitions. So they are borrowing more money to fund their acquisitions, which is good because even though they have more liabilities, but they also have more assets as well to generate more revenue. And let's look at the divestment gains. It was 1.8 million in 1Q versus 4.7 in 4Q. So we talked about this earlier. So if we have the adjusted DPU, which we only looking at the business operations, the raw business operations, the adjusted DPU increased by 3.3% from 2.05 cents to 2.1 cents, which is not too bad, I would say. If they can increase this quarter on quarter and year over year, then you will see this REIT being a strong powerhouse in the future. Okay, moving on, let's take a look at the healthy balance sheet. Okay, so it's comparing between last quarter versus this quarter. Total value of investment properties last quarter was $10.8 billion. This quarter is around $10.7 billion, so a slight drop. Total assets 11.2 last quarter, 11.1 this quarter. Liabilities relatively flat, 5.08 versus 5.06. So if you look at the net asset value, it actually dropped by quite a bit from 5.68 billion to 5.64 billion. NAV per unit decreased slightly from 1.33 to 1.32 per unit, and they explain here the decrease is due to the group investment properties, mainly due to a net translation loss from weakened HKD, JPY and AUD. So they are blaming on the foreign currency rates lah, which is fine because it's not a big drop, but usually we like to see it increase. Okay, this is what y'all came for, right? Distribution, dividends. For the distribution, the amount is 2.161 cents per unit, and then the XD is 27th of July, which is past. So if you are holding shares before the 27th of July, you will be entitled for this distribution, and it's going to pay you at the 7th of September 2021. Okay, moving on, let's look at capital management. Prudent capital management. This is how well the company is using the debt. Total debt outstanding decreased by 38 million, mainly due to lower net translated foreign currency loans and depreciated against SGD. Accordingly, gearing ratio decreased by 38.2%, with the average interest rate remain at 2.2%. If you look at the aggregate leverage ratio, this is how much of the company capital is financed by debt. So you want it to be as low as possible. Anything below 40, I think that is fine. And then we look at the interest rate, 2.2%, that's basically a very cheap rate, right? If you borrow money from 2.2%, I think that is a very good deal for a large company like that. Yeah, it's even lower than your HDB CPF loan rate of 2.6%. So that's all I want to cover for that. Let's look at a well-staggered debt maturity profile. This is basically a chart showing how much of it is denominated in foreign currency. I won't go into the details. Proactive interest rate and forex risk management. So I don't want to talk about this as well. They're just telling you how good they are in hedging. Portfolio review. Okay, this is the more interesting one. So over here at the left, you can see the geographical diversification for their assets under management. How much is located in Singapore versus the other regions like Hong Kong, like China, Japan, and then for the revenue, how much each of them is contributing. Interestingly, you can see even though the gross revenue of Singapore is the biggest at 29.4%, their assets under management for Singapore is not the highest. It's actually Hong Kong, 24.4 versus 24.1. But Hong Kong is only contributing 17.2% to the revenue. So you can see a mismatch right here, right? It means that their Singapore property is actually much stronger. Okay, and then next we take a look at the occupancy level. So you can see Singapore occupancy rate from 98.1% drop a bit to 97.6%. For Hong Kong, it's close to 100%. For Japan, it remained at 96%. But overall, you can see that their portfolio occupancy has improved from 97.5% to current quarter 97.8% due to higher occupancy in South Korea and China. The rest of them remain quite stable. Okay, lease expiry profile, I won't talk too much about it. This is basically how long your lease is going to expire, and then your tenants will come and renegotiate the rates again. Top 10 tenants by gross revenue. So you can see the largest tenant is CWT, this is a logistics firm. Coles Group, which runs a supermarket in Australia. Equinix, which is a data center in US. JD, which is an e-commerce store from China. Cainiao, Alibaba. Let's take a look at the diversified tenant trade sectors. Most of them is coming from F&B products. Second, coming from consumer staples. So these are more essential industries even during this pandemic season. Investment review. Let's take a look at the proposed acquisition of NICE Changi South Street 2 Singapore. Purchase price was $24.5 million. And let's take a look at the occupancy. The property will be sold with a vacant possession. The manager is in talks with an international third-party logistics to lease the property as anchor tenant. So they are trying to find a third-party logistics firm to be the anchor tenant so that there will be consistent and recurring revenue from there. Projected stabilized NPI yield is around 6.2%. I think that's generally a good yield compared to what the distribution is paying out. So it's located near the Changi Business Park, Expo MRT there. Okay, the next slide is on Mapletree Logistics Trust portfolio at a glance. All these I have gone through before, but it will just show you a one-page summary of the important things that you want to know. Okay, let's take a look at the business outlook. Global economy is gradually recovering, aided by higher rates of vaccination in developed countries. However, fast-spreading mutations of the virus may slow down the pace of economic recovery, while geopolitical tensions remain at risk. So they are telling you, although the economy is recovering and they are expecting a good growth, but they are cautious because there may be things that are uncontrollable, like the different variants of the virus, right? Especially the Delta variant, which is spreading really fast, and also the geopolitical tensions between US and China that may remain a risk. And demand for warehouse space has remained resilient with stable occupancy and rental rates. That's true, especially with the rise of e-commerce. Manager will continue to focus on maintaining stable occupancy rates and strengthening the portfolio. while maintaining a prudent approach to capital management. This is basically just being politically correct. They are telling you they are wary, they are telling you they are very cautious, they don't want to be too ambitious or aggressive, so they're telling you remain calm, we'll do our best. Alright, so that's about it. In the appendix you can see more details, but I won't go through that. The rest you can read yourself lah. But I hope this analysis has helped you in understanding the Mapletree Logistics financial results and business outlook. So I hope this has given you a better insight and knowledge of how Maple Logistics Trust is doing for the first quarter of the year. And if you have found value in today's video, do remember to give a like at the bottom of the video and consider subscribing to my channel for more investing related content. My name is Christopher, this is Honey Money SG, steering young adults to financial independence.